So the topic for today is what's next for inflation, interest rates, future taxes, and our national debt. So that's going to be kind of at the tail end of this. And I don't want to pretend that I have all the answers, but I do have some fun ideas. And when I say fun, I mean constructive ideas, things that I think we need to be focusing on, especially as we're coming out of this. Like always, as we start going through, where did my disclosures go? They are hiding. I need to unhide my disclosures. I apologize. You would think I would not be rusty. I've done enough of these that I would be good to go. So disclosures, of course, these are my opinions and that the opinions of Vance Wealth, not of Raymond James. Moving on. Okay, so we're gonna talk about what's going on with the market correction and the recovery that we're in right now. We're gonna address what the House Representatives passed, called the HEROES Act, phase 4 of the stimulus. And then we're gonna talk about what's next for, kind of question mark, like what's next for economic growth, interest rates, inflation, taxes, the national debt. All of those topics there can be probably addressed on separate webinars for 30 minutes each. So we're gonna do super high level, but you are gonna leave with some tangible ideas that, hopefully you guys will share. And don't forget to share this. And so, a lot of reason we do these webinars, we want to educate you, but hopefully the message is resonating. I know many of you have attended quite a few of these. So I hope these are continuing to be valuable, and please continue to attend. I do want to give you a couple housekeeping items. So if you recall from the last few, you do have the ability to ask a question. So if you look at your toolbar at the bottom, it says Q&A. Just go ahead and type your questions in. And then once I get to the end of this, I'll review. So as I'm saying stuff, if something pops up, just type it in. It'll kind of wait for me in the queue, and then I can go in and read it at the end. I do find this a lot more lively if we can cover what's on your mind. Everyone else is on mute, so you don't have the option to unmute yourself. So that'll keep me moving forward. And we are recording the webinar, so we'll email it to you by the end of the week whenever it's ready. And then a couple other items. We will be doing what we're calling webinar lucky number 13, which will be on June 23rd. So 2 weeks from today, same time, same place. I'm going to share what I call my controversial and crazy ideas on how to fix the student loan crisis and repair the Social Security system. There'll be some other stuff, I guess, woven into that, but I'm going to kind of go through some of my ideas there. And then again, starting in July, we're going to go to every month. And we're going to be hosting webinars on the 3rd Tuesday every month. And we might go back to every other week, just depending on your interest, but let us know. We want to know your thoughts. I enjoy doing these. It does take time to prepare them because there's a lot of fresh content. But if these are valuable and you want the frequency to be more often, then don't hesitate. Don't be shy. Let me know. So, okay. So moving on. So many of you know, and many of you have attended every year, and I've been doing this for over 15 years. I do an economic and market update. And this was actually from the presentation in January. And it just was kind of talking about market corrections. And the reason I put it in there is 2019 was a really good year for the market. And it's just a reminder that, market corrections happen and it's part of investing. And one of the things that I think we've all been hardwired to do is be fearful of the corrections, fearful of losing money, fearful of these temporary events that really define the stock market. And, when we look at market corrections, they're swift and they come without warning. Their length of stay is unknown. They are not pleasant when they're around. They leave scars on those that react poorly. They are temporary and necessary. They are vital to the long-term return, and they are essential to the health of a long-term bull market. So I think when I read that in January of this year, it was kind of like, yeah, we know. But I feel like today, even more so than ever, it's kind of it's a good reflection on, this stuff is real. We didn't predict that. I didn't start the year saying, hey, we're going to have a big correction this year. We've been bullish for what was going to happen in 2020. Clearly, what's happening with COVID-19 was way outside the scope of our ability to make any predictions. And so, but the thing that we do know is market corrections show up. And the one thing that I just want to remind all of you, and I've had a lot of one-on-one conversations with those of you on the call, and when we had that initial decline, there was a sense of panic, but concern, and rightfully so. And part of our job is to make sure we remind clients that we have a plan, we have a financial plan, we have a game plan, we got to stick to our plan. And these things are going to happen, whether it's under COVID-19 whether you're living through the September 11th dynamic, living through the Great Recession, living through all these things. These are all normal parts of being an investor. And, I truly have faith over a long period of time that these are all going to be bumps in the road. But while you're in the middle of it, it's painful. One of the things I'm really happy to report on is that we didn't have any clients go to cash. And that's really, when we build a plan for somebody, part of the plan, part of the risk management strategy is we need to set up a plan that can actually deal with volatility, and so that clients can weather the storm, not only financially, but emotionally. And so again, healthy reminder of this market correction. We've seen a nice bounce. I'm going to go through some of the data, but we're not out of the woods. We're going to see volatility ahead. And, again, instead of being fearful of it, embrace it as part of investing. It's part of the admission, like the admission ticket for being an investor. You have to pay the price to understand market corrections and be willing to ride through these ups and downs. And that's why we diversify assets between cash or short-term investments, bonds, and then longer-term assets like stocks and real estate. And that's why diversification is so important, because it helps deal with these types of environments. So I didn't intend to spend this long on market corrections, but it's a healthy reminder. And for those of you that are younger and still saving, market corrections are the best thing that can happen. We have positions that from the bottom are up 60, 70%. And that's not because we're so brilliant. It's just because things got so low and they've now bounced back. And so people who are investing on a weekly basis, we're picking up some of these amazing bargains down at these lower prices. And so again, good reminder here, this is normal. Again, market corrections are normal, I should say. Okay, so what was so painful and so shocking is this was the fastest 30% decline in the history of our stock markets. And if you look at some of the big sell-offs in previous periods of time, and I'm going to get my little pointer here, you can see we had this happened in 22 days. We had a 30% decline. The closest was the Great Depression, 1929, or I should say the start of the Great Depression, which was a 31-day decline. And then you can see other periods of time. So more normal, like 2000, 2007, was where this decline was very protracted. And so one of the things as an investor or as a worker in the economy, would I rather have a sharp sell-off with a quick recovery or a prolonged sell-off with a more drawn-out recovery? And I would really prefer the former. I would prefer quick sell-off and then start recovering, because it's easy to move forward. When you go through these markets where they're long and drawn out over a year or two, it's a lot more painful because it's, you're seeing this pain that just gets prolonged and really drawn out. And I don't like that. So we had the fastest 30% decline ever. And this chart should not surprise anyone. We just lived through, and I think this was as of June 3rd. You can see this down here, June 3rd. This was the largest 50-day gain in the market ever. So if you look here, these were periods in time in the most recent history going back to 1975. What was the 50-day percentage change? This 37% is the largest. And then what this actually shows is, okay, after the 50 days, how did the market do 3 months, 6 months, 12 months in those environments? And so if you notice, 1 month after the 50, kind of mixed results, not big returns. As you go out to 1 year out, the average return was around 17%. So we don't know what that future is going to look like for us. I'm not predicting that, but it's pretty interesting to see that even though we've bounced back, history would suggest that the next year is still going to be quite strong for the markets. But the real important message with the last two charts is when you have the most severe sell-off, it is followed by the biggest or the largest positive gain, and that's normal. That tends to be what happens in the markets. So again, we feel really confident that our clients stuck to the game plan. Part of it hopefully is us being there by their side, but it was a really tough 3 months for the stock market, especially. The economic challenges are still ahead of us, but I feel like the worst is over in the stock market. Again, still volatility ahead, but the worst is over in my humble opinion. Now, this has been a chart that you have seen in previous webinars that I've done, and I just want to go through it again. So we talk about what the recovery is going to look like. And Raymond James, one of our analysts, put together this idea of we're having a K-shaped recovery. And the simple idea with a K-shaped recovery is that not all businesses, not all sectors are going to recover in the same way. They're all going to have their own type of recovery or their own kind of economic response. And that's very different than like a V-shaped recovery, right? A V-shaped recovery means the economy goes down, it bounces back, and kind of the whole economy makes its way back. What's clear coming out of this is that there's industries that are thriving, there's industries that are dying. And then there's those industries that are just struggling, and they're all struggling at different levels. So if we think about the one scenario is we started the crisis here and we moved down, and we're going to kind of show you what happens with the K. Companies that were over leveraged, meaning lots of debt, and they're very heavy, cash flow driven small businesses, a lot of these are dead. Unfortunately, we're starting to see that pop up in a lot of communities where small businesses are shutting down. They're not going to reopen their doors. It's really a shame. It's an unfortunate, it's really the biggest kind of unfortunate part of what we're dealing with is these small businesses that may have been around for decades that are going to have to shut their door because they had to burn through too much cash. Just the operating costs are too high. And unfortunately, we have a bunch of these businesses that are going to go out, that are not going to come back. From a public perspective, we're already seeing companies like in retail file bankruptcy, and they're going to restructure. They have a little bit better access to cash, but we have a fair amount of these businesses that really are at a dead end. They're not going to recover. And then we look at, okay, well, what's next? So you look at this little blue dot here: airlines, entertainment, and car sales. So what does that look like? So obviously we dipped down here. What's happening in the airline space? Well, right now in car sales, entertainment, we're getting a little bit of a bump. You're getting companies to bounce back, but we have a concern that those industries are likely going to kind of fall back down because they have some real challenges ahead of them. In terms of airlines, right? What's their business model going to look like? They're not going to be able to fly at full capacity. A lot of the business travel is going to go away or be significantly reduced. So there's going to be some more challenges in that environment. What's it going to look like going to a movie theater? What are all about all the businesses that cater to that? So this is where we look at this kind of blue dot is kind of coming through this, and we think they're going to have a kind of a much tougher comeback, right? Then we look at the third kind of category: home improvement, surgeries, technology, right? These were the businesses that got hit initially, but now are bouncing back strong. Like businesses like Lowe's, Home Depot. Again, we're not supporting any individual stocks in particular, but home improvement sales have been through the roof. We're starting to see elective surgeries open back up, and technology has been obviously a really good sector to be in. And so we're seeing this bounce back pretty quickly. And then the part of the economy that really just took off during all this was medical supplies, e-commerce, and streaming video, right? So when you think about the Amazons of the world and streaming video like Netflix, these were businesses that right when this started just took off. Companies like Zoom, right? So you're seeing these industries where they're just thriving because we're having to deal with people they're having to stay safe at home. And so the reality is there's businesses that are thriving. So when you think about this K recovery, it's really, we're going to have winners, we're going to have losers, and we're going to have companies that are going to struggle. And that's going to be the reality for several years. We'll get through this, but it's going to be the reality for several years. Companies are going to have to adjust their business model. The good and bad of all of this is when we have disruption like this, it forces change. It forces companies to change the way that they're doing business. And so we don't think this is going to be an exception. And honestly, it's a healthy thing to have change, but except if you're unfortunately in these businesses where you just can't recover. All right, so we're going to go through a little bit of an update on what's happening on the Washington front. So that thus far we have authorized about $3.6 trillion of relief, which represents 16% of GDP. So this is the biggest relief package we have ever seen. So this was bigger than the Depression, bigger than World War II dynamic. This is the largest. And we've already kind of highlighted phase 1, 2, 3, and 3.5. Now what we're looking at is a proposal, which is the Democrat proposal coming out of the House called the HEROES Act. This was passed by the House. I have another slide next. They're projecting basically, I think it's another $3 trillion of money going out in this. And so let's talk a little bit about what they're talking about. So The relief, again, this is the phase 4. So it passed the House. Let me see what those numbers were, 208 to 199. So still pretty close. The Senate has it. I don't know the timing on when that's going to go through. My sense is I don't think it's going to pass the Senate. I think this is too big of a package. And again, this is just me talking, too big of a package. We needed, like, for lack of a better term, when this thing started, we needed like a bazooka, right? We needed things to just get out there and stimulate the economy, stop the bleeding, stop the panic, get things back to some normalcy. Now we need, and I mentioned this last time, more of a rifled approach. We need much more focused aid, and $3 trillion is massive, right? It's actually equal to what has already been doled out. And so these are some of the proposals. About 1 trillion for state and local governments. The state and local governments are going to need help because of the massive amounts of unemployment. They're going to run into some budget shortfalls, so there's going to need to be money there. How that gets doled out is a different question, but there is money that's needed. I can't really speak to the size of these because you start losing me at $1 trillion here, $1 trillion there. Unemployment insurance, I think this is one of the dangerous areas. This is the most unemployment insurance prior to this was state driven, not federal driven. Because of the severity of COVID-19, the federal government added on $600 per week for this through the end of July. So $600 per week on an annualized basis is $30,000. So people who are on state unemployment and on this are getting oftentimes more to stay home than they would be to go to work. So this is a dangerous one because as businesses start to come back, a lot of the people who are working at the restaurants or the theme parks or the movie theaters, they might be making more money sitting at home. This is a very dangerous one to pass because you don't want to have an economy that's trying to get back, but then you can't find workers because they're actually incentivized to stay home. So they need to, in my opinion, relook at this one because this is, I think this is a really bad idea. Let it go back to the states. If they want to give the states support to let them continue with their unemployment program, fine, but it needs to be much more regulated based on, okay, do we need to have a technology system in place that says, if you're an employer trying to hire someone back and they refuse, you type their data into, their social security number into a database and then they're refused the 600. There has to be something in place. This was designed for people who cannot find work. If you can find work, but you choose not to, you are not entitled to this. And so this is going to be a massive fight. The reason why I don't think the Senate will pass this is because of this issue right here, because it's going to really hinder our ability of the economy to get back to work. New round of direct payments. This is a little bit of kind of along the same lines. I don't think this is going to pass either. So we're now talking about $1,200 per individual and a dependent benefit of another $1,200. So that was raised. So if you have a family of 6, you might get a check for what would that be? $7,200. So this is going to be another one that's they're going to fight. They're going to say, well, if we're already paying unemployment, why do we also need to send this stimulus out there? Because people are going back to work, and I know California's a little bit different. Los Angeles is a little bit different, but around the country, we're seeing this. I don't know if I have this seems so insignificant when I'm looking at 100 billion, but obviously that's important for rental payment assistance. I don't even know the details in there. They are making some changes to the Paycheck Protection program. Don't want to spend a lot of time on there. I think they did a carve out for this one alone to clean it up to allow for some different use of that money, increased Medicaid funding, tax provisions. They're talking about trying to get rid of the SALT cap, which for California taxpayers, you guys will love that. So that basically means that there's no cap. So right now the cap is $10,000 on your state and local taxes. So your state income tax plus property taxes. So if your property tax bill is 15 grand and your state income tax bill is 25,000, that's $40,000 of taxes that you have to pay. Under the current system, you're only able to take a deduction on your taxes for 10 of that. You're capped. Under this provision, they're talking about temporarily suspending this so that you can deduct that again. So I know that's going to be a big push because that impacts the higher tax states on the coast. So we'll see. So some of this stuff's going to be fought through. I think that the unemployment insurance and the direct payments, because it's more of a bazooka approach. We need more of a rifled approach. This is where the big fight is, and that's where most of the money is. Some of these aren't as big from a dollar perspective. What's not in the bill? Infrastructure spending, right? We keep talking about let's get people back to work. Why are we saying, if we're starting to open back up, we got to get people back to work. So if there's not jobs out there, if companies aren't finding jobs, let's get money spent on our infrastructure. Let's get things built. Let's move forward. Liability protections, in terms of people who have debt to service and they're not collecting rent because people can't afford it. So there's things in place. The next step, you think the negotiations are going to continue on. This is going to be a big issue that's going to be fought. I don't know if we're going to have a lot more stimulus, which I'm kind of okay with. I think that, to the person, meaning, to the individual, there's a lot of pain still out there, but collectively, a lot of this relief has really stemmed a fair amount of financial burdens. But there's still plenty of people who are struggling, but it's not as many as I think the media is kind of making things out to be. So the one thing that I want to be clear about, and the title of this slide says elevated pullback risk, but it would be normal. So given that we've bounced back so fast in the last 50 days, we do expect, which would be called normal summer volatility. So normal summer volatility, markets are getting a little bit valuation. The valuations are getting a little stretched with this bounce back. We're at some higher levels that we haven't seen back since 2000. A big part of that is also because earnings are getting hit, right? Companies' profits are declining pretty quickly. So it's kind of a combination of the market bounced and profits are going down. But, these profit decreases are probably going to be for 2020 only. In 2021, we'll start seeing a rebound. So if you look on the right side, it shows summer pullbacks are not uncommon. So this circle shows basically the performance between Memorial Day and Labor Day. So if you go back for like the last 10 years, most of the time we're positive, with a couple few exceptions, but these blue bars show like large pullbacks. And so basically that shows what's a typical pullback. And so we tend to see, 5-6% volatility. So from these levels, we would not, it would not surprise us to see a 6 to 10% pullback, kind of on our way to continue to move higher. But that's not adjusting our investment strategy. We're not trying to guess here and say, let me miss a few bad days or a few bad weeks. We want to make sure we're invested with our plan, the plan that we put in place, and not let this stuff deviate. But we do expect that we might see some volatility this summer, because that's just typically what happens. So it's nothing out of the ordinary. All right, so I'm going to get into some economic data here, and then we're going to kind of finish up with some of the things and kind of, in my opinion, of where I think we can really make some changes from what our country can do, what our leaders can do. So at the end of the day, when we're trying to grow our economy, what are we essentially trying to do? We're trying to grow what's called GDP, which is our gross domestic product, right? And so that's just an economic indicator that measures the growth of the economy, the growth of all of the economic inputs from, spending money on your house, to your car, to food, so to healthcare, all of the things we spend money on. And so a healthy economy is when GDP is growing. A recessionary economy is when GDP is contracting. We already talked about this weeks ago, that we're in a recession. It's funny now, we're starting to see articles, oh, we're in a recession. It's like, yeah, we were in a recession, weeks ago, even months ago. So there's a lot of data on here. I want to pay special close attention over here to GDP growth. So if you look at, we have a lot of data here. This shows the 50s, the 60s, the 70s, the 80s, the 90s, 2000, and then the 2010s. And you look at what's called growth in real GDP, so inflation adjusted GDP. So this last decade, our GDP has only been growing by 2.3%. And if you look at how it grew, like in the 50s and 60s, it grew at 4%. And this is one of the things that, all presidents talk about, is like, we want to grow the economy. We want GDP numbers to be north of 3%. And that's been tough for the last 20 years to attain. In the 2000s, that GDP was only 2%. Well, we have some structural challenges right now which are causing that. So if you look at what drives GDP, is there's two inputs: growth in workers and then growth in output per worker. So in other words, productivity. So the way you grow an economy is you have to have more workers, and those workers have to actually be more productive. And so if you look, which is remarkable to me, this last decade, you can see the productivity numbers were at 0.9%. That was essentially the worst productivity numbers for a decade on record. And why is that? We have all this technology. Shouldn't we be more productive? Well, some of that might be training, education. I can't really even speak to why that is, but that is something we need to work on in order to get our productivity numbers up to improve GDP. that's an area we just have to focus. We gotta figure out how to get businesses more efficient, how to get workers more productive. Then the other part is growth in workers. And I'll talk a little bit about this later, but growth in workers means we have a new immigration policy to get more workers in here. We got to retrain our workers that are left out of our current economic environment, because if we want true growth to kind of lift us out of this dynamic, we're going to need a healthy GDP. We're not going to be able to do it with 2% GDP. It's got to be bigger. It's got to be more like 4%. And I'll come back to this a little bit later. I just wanted to share a visual with you. Okay, so the Fed and interest rates. And so this is about a 20-year history of the Federal Reserve and of interest rate policy. And you can see back in basically 2000, interest rates were at 6.5%. I mean, I know that wasn't that long ago, but the idea of getting 6.5% like on cash seems so foreign to any of us because it's been so long, right? So that was 6.5%. Just prior to the Great Recession, it was 5%. And then you can see what we've been living through here. If you kind of follow my red dot, we got up to 2% and now we slash back down. So for those of you who are enjoying some of that nice interest payments from your credit unions or your banks, that's gone. And what the forecast is, you can see interest rates essentially at zero for the next 3 years. So it's hard to go much out beyond that, but that's really the projection, is that that rates have been slashed to zero and we're going to stay there for the next couple of years. So what does that mean? Well, the first thing that means for us as investors is the only way we're going to get return is to take risk, which is one of the reasons why we've been talking about this, why the stock market has been doing well, is because cash has to go find a home. And when you're making zero, you're not going to tolerate that for too long. So the policy of the Fed and the interest rates is going to be in this kind of lower for longer environment. So this is another way of looking at interest rates. So the Federal Reserve controls the Federal Reserve rate, or the Fed funds rate. And then this is representing the US Treasury. So what the US government bonds are actually paying if you buy them as an investor. So you can see this top dotted line shows December 2013. So 7 years ago, a 10-year government bond was paying 3.04%, and a 30-year bond was closer to 4%. Not bad on the return, right? Now that 10-year bond, when I say now, March 31st, we're actually in a similar level, but March 31st, 0.7%, and on a 30-year Treasury, 30-year government bond, 1.35. Now, this is called a yield curve. The entire yield curve is actually below the rate of inflation. So when you're below the rate of the inflation, what does that mean? That means if you invest in these, you will get a negative return after inflation. And that's what this chart shows. So this chart goes back to 1958. The blue line shows what the 10-year Treasury was paying. It got as high in 1981 as above 15%. And then you can see we've been in a total collapse of interest rates, and we're now down here at 0.7%. The gray represents inflation adjusted. So you can see inflation adjusted rates. We're at a lowest point we've seen since about 1980, where we're seeing negative returns. So the real rate right now on a 10-year Treasury is negative 1.7%. So think of that. You're investing your money in what you would deem as a safe asset, but who thinks a safe asset is if you buy it that 10 years later, you literally lost 1.7% per year against inflation. That's one of the quickest ways to destroy wealth. So while bonds can be a good place to park money, right now it's not a good long-term investment. It's just a good place as part of your overall allocation, but not a good long-term investment because of the dynamic of negative interest rates. And this is pretty typical. This is the Fed's playbook. When the economy goes into tough times, they slash rates, people can refinance, get cheap money to help grow and stimulate the economy. I don't want to spend a ton of time here. There's a whole list, and we're going to share the presentation with you, but you can see, these numbers are changing quickly. So as of the time, this was March 30th, the stimulus was only 2.3 trillion. Now we're 3.7 trillion. I mean, we're just throwing away trillions of dollars at a time. And if you look down here, what we're projecting our debt to grow to. So right now we're 79% of GDP. And we're projected based on this new forecast to be over by 2030, over 110%. And that's what gets really dangerous, right? When federal finances, when your budget or when your deficit is so large that it becomes larger than your economy, how do you pay for that? And the short way, there's two ways to pay for it. Number one is inflation, and number two is higher taxes. both of which we do not like. So what's a more palatable way? Do you think that politicians would rather tax you more or create inflation that kind of secretly takes away your money? I would say it's the latter, it's the inflation. So the Federal Reserve has been trying to create inflation and they can't. They want inflation so bad because it's a way of devaluing your assets, devaluing your money slowly, versus taxes feel like they're taking your money. But essentially over a long period of time, it can have a very similar impact. It's just a lot more popular doing it through inflation because you can't see it immediately. It's just when you look back and you say, wow, that did take away a lot from me. Think about that. If any of you started working in the 60s and 70s, a decent wage in those times was, somewhere between $5,000 and $15,000. Fast forward to where we are today, it's much more, above 100,000. So that's the impact of inflation, is that, that you're making more money, but really on an inflation adjusted basis, you're not necessarily. Okay, so this is what I would call kind of the fun part of what I want to go through. So hopefully the more creative part of our conversation today. But some of the things that we're just getting questions on, that are kind of on people's mind, why is the stock market doing so well when the economy is clearly in a recession? And the short answer to that is the stock market is a forward-looking indicator. So the stock market went down first before we were in a recession, and anticipating that we would be, and it's bouncing back first, anticipating we're going to come out of this. So that's really the short answer. The other thing is, and this is the hardest thing to get to wrap our mind around, is that many of our US companies are doing so well because they're benefiting from a global economic system. So even when maybe our US economy isn't thriving and booming, they have now a marketplace that all over the world, all continents, to do business in. And so, if you think about, they were just limited to the US only, and our economy isn't booming, they can't really grow. But now the fact is the rest of the world has continued to grow and they're adding new marketplaces. So the stock market can do fine because these companies are participating in around the world. So that's a big reason. So there's a lot and there's more to that, but that's kind of the high level. And then the next one I have here is, when is inflation going to be a problem? My short answer is it? And I guess that's not really an answer. It's just kind of another question. What we're seeing right now is technology is driving costs down. When you see what an iPhone can do today, when you see what technology is doing, how we're getting things delivered to our house, how we're eliminating the middleman, how we're now using apps to do things for us and connect us in a way that people used to, where it's driving costs down. And so that's very deflationary. We also are in an environment where energy is cheap and plentiful. That's also deflationary. So right now, the Fed's biggest concern is deflation, the declining of prices. They cannot allow that to happen, which is why they are willing to pump so much money into the system. So I don't even know if I can answer when is inflation going to be a problem. We're currently in an environment where it's not an issue. And I know it's kind of a weird thing to just say, well, just keep kicking that down the road. Eventually it will be. I honestly think it would be healthy to have a little bit more inflation. Because I think that would help us with our tax issues, with our debt issues, to have a little bit more inflation in the system. And, some of the stuff that I say is, I studied economics in college and it's not in that economics playbook. But some of this stuff is very counterintuitive, and inflation is not a problem. And here's another part of why this is. Won't low interest rates cause inflation? So the whole theory behind that is, if interest rates are so low, then I, along with everybody else, will borrow so much money to go spend, to build businesses, because money is cheap. And if everyone's borrowing money to go spend and build and create, that's going to cause inflation, right? Because you have all this money chasing goods. And if we have all this money chasing goods, it's going to drive prices up, which is the definition of inflation. But I take it a different path. People aren't reckless with their spending of borrowed money. People are careful with their spending of borrowed money because they don't want to blow themselves up financially. Think of the impact for me. If I can borrow money at 3% versus 30 years ago, I had to borrow money at 12%. Isn't that deflationary for me? The cost of me borrowing is so much lower. So I actually don't agree with kind of conventional wisdom about what you see in the textbooks. I do think that low interest rates have actually caused low inflation, because this is not an extra cost to do business. It's not an extra cost to build a plant, to hold inventory, because the carrying cost of all this is extremely low, which then causes prices to go down. So again, that's totally opposite of what you would read in an economics textbook, but show me the case otherwise. We've seen this time and time again. As interest rates have dropped, inflation has dropped. So especially in our kind of new dynamic of the economy. And then the last one, which is probably the question that's the hardest one to even answer, is why is the US dollar so strong even when we are printing records amount of money? When you think about the dollar has a value because in America, we have an entrepreneurial system that favors growth. We have a relatively stable economy. We have a relatively stable political dynamic, again, when we compare it to the rest of the world. And we have policies in place that protect property rights. So we just have a healthy legal system in place. So that keeps the dollar strong. But if we keep printing more money, what's keeping that value? And I guess the short answer right now is the rest of the world is doing worse than us. So it's making the dollar so much stronger. But eventually this will catch up to us if we have if we continue with irresponsible spending. And that's kind of why I think we need to make some serious changes. I'm not a big fan of this new stimulus package and this bazooka format where it's just throwing money out to people. We're beyond the panic. We now need to be much more specific about how we're going to provide relief. And I'm okay with the relief. We want to keep things moving forward, but we need to be smarter about it. And unfortunately, I'm not seeing that from either side of people being wise. There's a lot of fighting going on, and I think this is going to be a battle we're going to see right through the election. So here's where I get into some of my solutions. So I kind of have like 4 big topics that I'll kind of opine on, I guess. So thanks for allowing me. Usually I just kind of, I do have opinions, but I kind of just deliver a bunch of facts and kind of stick to it. But I want to talk to you about some of the things that I think are going to be paramount to our change. One of the things that I'm kind of going through here is, I'm talking about some high level stuff. I'm not getting into the weeds of how to fix it. I mean, I'd love to, but that's for another time. And this is good stuff. I might try to record this as a separate item, but there's some major things that we have to fix. And this at a very high level, this is it. We are in a low growth economy. I showed you on a few slides back, we're in a low growth economy where GDP has been growing less than 3% for 20 years. We have to get more growth. There's just no shortcut to this. If we're going to spend at this rate, if we want people's quality of living to go up, if we want more access to healthcare, better education, we have to have growth. Without growth, none of that other stuff is possible. It just cannot happen. The good news is the amount of innovation that's happening in the technology space and the medical space should provide this, but we need to make sure our politicians and our policymakers are focused on these areas and held accountable. So why are we in a low growth economy? So one big reason is demographics. We have an aging population and we have really low birth rates here in the US. If you look at the data, we're not replacing ourselves right now. So the easiest way, and I talked about this earlier, is we have to grow the number of workers. We have to get more people in the workforce to grow our way out of this. And I know living in California, especially living in Los Angeles, it's like we don't need more people. The rest of the country is pretty wide open. We have a lot of space to be able to accommodate people. And, we need, a couple ways of doing that. Number one is you got to start at home first. Education. We need job specific training. I have 4 kids in high school right now. Well, 2 step kids, 2 of my own, but 4 in high school. The stuff they're learning is the same stuff I was learning back 30 years ago. They're bored out of their mind. They are being challenged in some areas. They're bored out of their mind. Why aren't our kids at 15 starting to learn real skills that they can take into the workforce? It's not happening. And we need job specific training and we need to retool our whole university system. So you're not coming out of school with $200,000 of debt and without maybe many job skills. We have to rethink how we're doing this, and we have to retrain America for the future. That's where our focus needs to be right now. If we can't get people put back to work after COVID-19, you know what? And you're going to be sending people checks. Again, I'm not a big fan of that, but there should be a retraining purpose to that. There should be a retraining requirement. You got to get people retrained. You cannot leave a big batch of society out of the mix. It's not going to allow us. We're going to have more civil unrest unless we get this issue focused on, and we got to start earlier. So the next one is comprehensive immigration reform. Since and this is not a Trump issue. I know many of you will have Trump issues. This is not a Trump issue, but we haven't had over the last 4 years a lot of immigrants allowed in, and we have a lot of immigrants that are actually educated here and have to leave that can't stay. I think the numbers of immigrants that are allowed to stay is in the 500,000 or 600,000. I could be off with those numbers, but it's in that range. That number needs to go to like 2 million a year or 3 million a year. And we have to get focused on, but getting the right people in here that are going to help fuel the economy, giving them the American dream, but in a setup where they can participate and help grow the economy. And I think that's going to be critical, because this third point, bring manufacturing back to the US. If we truly want to bring manufacturing back from China, have more control of our supply chain, things like medical supplies that we realized, we have a shortage of masks, we have a shortage of gowns. Oh, they all come from China. Well, that doesn't help us out. What happens when we have another emergency and we can't be self-reliant? We're going to have to bring that back, but that means we're going to need to make sure we have trained, we have a trained workforce, and that we have more workers willing to do the job. And so obviously manufacturing coming back is going to be a combination of people and robots. It can't just be people, because otherwise we're going to create inflation, right? Because we know in China, they can do most of this because they have cheap labor. That stuff comes back here. Our labor is a lot more expensive because our quality of life is a lot higher. We are going to need to have that. It's going to be a part of automation, more robots, because that's going to then help keep inflation under control, because it's going to be a combination of the two. So that's a big part of what's going to be required. And, unfortunately right now, I know we're dealing with a pandemic and trying to solve like just the immediate panic, but we've got to start dealing with some of these longer term issues that don't seem that hard to fix. We just need to get some leadership that can focus on this. And I feel like this is where we've been for the last 20 years. So this is not a new issue. The next one is, when we start looking at, why we're in a low growth environment, again, demographics is a big part. And maybe this is actually, I think I may have missed, I think one of my headers got pulled out of there, but nonetheless, how do we focus on growth? We need to focus on productivity enhancements. We need to improve our infrastructure. This second bullet point down here, government entities need a massive technology upgrade. If any of you have dealt with Social Security Office, Medicare, dealt with the SBA, I was dealing with the SBA with PPP loans, their computer systems are antiquated, they're terribly inefficient. We need a massive upgrade. We need to cut the number of government workers probably by 1/3 and invest in technology so that those that are still there can actually do their jobs more effectively. It's a terrible waste of money. We have to improve efficiencies. Corporate America is adapted to be, to be able to work at home and be able to be highly efficient. Our government entities from state, cities, local, they're doing it at such a slow rate. And I think California is not nearly as good as the rest of the country, because we have such good weather that, you don't have to stay home because of a snow day. You don't have to stay home because of a hurricane. The rest of the country has had to prepare for this. So we need a massive upgrade in technology to downsize some of those fixed costs and to be able to be more effective. And then we have to embrace the work from home reality. We live in Santa Clarita, feel very fortunate. We're going to continue to operate with my employees coming in. It's a 2 to 5 mile commute, not bad. If we all had to go to downtown LA and spend 3 hours of our day in the car, and we're not going to be as productive. So the office dynamic is going to change. I think we're going to see more people moving out to suburbs, kind of realizing, these bigger houses are not too bad, especially if I have to spend more time at home or work from home. And so this is a big part of how we get productivity enhancements, is embrace the work from home reality, because that'll give a better work-life balance, because we'll spend less time commuting and things that are essentially wasting time. So this is my last slide on here on kind of the continued piece. We are in a low growth economy. We need to focus on growth. Why are we in a low growth economy? The debt. We have massive federal and corporate debt. So the big solution that I've been talking about this whole time is we have to focus on growth. We need to get inflation back, right? Because we need price increases, because if we have price increases and you keep taxes level, does the government collect more revenue? Yes, because the prices of everything are going up. So modest inflation, higher than 2%, we probably need it closer to 4%. That's going to be a way, and I know this is counterproductive. People don't like hearing about this, but that's going to be a way to help deal with this debt burden that we've gotten ourselves in. And it's like we can point fingers and talk about how did we get in this, who's to blame, but at this point it doesn't really matter. Let's find a way to fix it. We need to lock in our federal spending. One of the hardest things from the federal government perspective is that, their budgets, they get automatic increases, all these inflation adjustments, because our spending is so out of control. we have to start locking that in. And the government spending process is so broken because in order to have a successful decision around how to spend money, you need one of two things. You either need a profit motive, meaning these decisions will allow me as an entrepreneur to make a profit and I'm willing to take the risk. So you either need a profit motive to keep costs under control, or you need a fixed budget. A fixed budget meaning we're going to build the train, right? So we all know about the California train, right? To the high-speed train. This thing is like 6 times over budget, 6 times. And again, that number might be off. So if you have better numbers for me, I might be embellishing that a little bit, but it's so over budget that it's ridiculous. And it's because there's no profit motive. It's not your money. It's not their money. It's just taxpayers' money. They don't care. So in order to get control of this, you have to either get a profit motive involved with getting a more public-private partnerships, or you have to have fixed budgets that you have to be held accountable to. Otherwise, you can't do this. This is going to run out of control forever. Fix Social Security. I'm going to address that in 2 weeks. It's easy. It's math. This is the easiest thing to fix. I know some people want to get rid of it. I'm kind of the pragmatic person. You just can't get rid of it, but it's easy to fix it. So we'll talk about the math next time. And then refinance our debt. I know there's already been some chatter. I know some of this is happening behind the scenes, but if you can refinance debt at less than inflation, start issuing 50 and 100-year bonds. You know, if we can lock in our rates at 50 or 100 years at 2.5%, let's do it. So that's what we got to focus on, is having this long-term approach of how we're going to handle this massive debt problem. And then tax policy. So this is my last piece for today. We need a pro-growth but fair tax policy. And I know I might get in trouble with some people on this. So, you know, you can shoot the messenger, or we can have an offline conversation. But the biggest thing that I struggle with is we have a very healthy, robust economic system. We have a very healthy legal structure of property rights that allow people to basically, you know, have certain rights that they can function, run their business, take care of their family. And the thing that blows my mind is that we have a system, it's a capitalist system that favors capitalism, meaning it favors capital. It has a tax on capital gains that's less than income. That's less than your taxes on your earnings, right? If you go to work. So my note down here is, if we value work more than anything in this country, and I truly do believe that's one of the work ethics that we, or the ethics that we have as a nation, we value work almost more than anything else. If we value work more than anything else in this country, why are wages taxed at a higher rates than capital gains? Why are people paying more in taxes on basically the work from the sweat of their brow, going to work every day? Why is that taxed at a higher rate than capital? And I know why that might have been initially set up, because we needed to form a society and have incentivized investors to come. I feel like we're beyond that point now, and we need to flip this a little bit. I don't say that it needs to be taxed differently. Why isn't it taxed the same? So that it doesn't matter if you're an investor and you make money as an investor, or if you're a worker and you make money as a worker. Tax it the same. If you're in a high income bracket, you pay it there, whether it's investment or working. If you're in a low bracket, then it shouldn't matter. I truly believe we have to make this more fair, more equal, stop picking winners and losers. And then this last piece here, eliminate the loopholes that favor certain industries. And so we have too many loopholes that favor industries. This last tax code was full of loopholes that just helped real estate, and at the expense of a lot of other industries. And so I think when you're going to give relief, it has to be broad-based relief so that it has a level of fairness to it versus just, you know, picking winners and losers. That's the most dangerous part about our tax code, is it is social engineering. It's picking, we value this, so we're going to give you an incentive. We don't value that, we're not going to give you an incentive. It's kind of the old adage of like a homeowner versus a renter. We value home ownership. So if you own a home, we're going to let you deduct your interest. We're going to let you deduct your property tax. If you rent, you can't deduct your rent. So it's just resetting the stage and making things less complicated from a tax perspective, and more fair. So I often don't get on my soapbox. Hopefully this was not preachy. I just wanted to share with you my thoughts. Hopefully these are a pragmatic way to deal with some of these real issues. There's probably more we can tackle. Part of the fun of doing these webinars is just to share some of my ideas. And again, I definitely don't think I'm right on all these. I welcome a debate. I'm going to check to see if there's some questions. But you know, sometimes you just got to get ideas out there and see what sticks. And you know, if we can pull things apart, then I'm totally fine to do that. So I believe that is the end. So, all right. So we have one question here that says, what do you think of the FICA holiday? So the FICA holiday basically, right, is where they the Social Security tax essentially is not going to be. I don't know if we have a FICA holiday for workers and for businesses. So it's an interesting thing. So let me answer this in like two different ways, or let me in a more of a roundabout way. You know, when we talked about all the stimulus that came in recently, like the PPP, getting money to business owners to help keep the businesses going, I would have preferred that instead of just sending checks out, that they just gave tax relief, meaning they said, okay, what's your tax bill for 2019? Oh, you owed 70,000. You know what? We're going to give you a credit for that. So we're going to send you your money back. I would have been a much bigger fan of just letting people keep their money versus the government doling out all this money. I think it's a lot more efficient to let people keep their money than to actually redistribute it, meaning I'm going to send it in and then the government's going to pay it out. So that's my preference. So on the FICA holiday, I mean, I like it conceptually for a temporary fix. I think we're getting past the point of it being necessary. You know, with the stimulus checks and with the unemployment insurance checks that are coming in, I think we're going to see people, and there's already articles written about this, that people have more money in their bank account today than they did when this started because of two things. They're making more money and they have nothing to spend it on. Now that's going to turn. And again, I know I don't want to be insensitive, because there still are business owners that are getting hammered. There are workers that are struggling, and unless we unless we get back after July 30th, it's still going to be a struggle. So I don't want to diminish that. So the FICA holiday is okay. I think that's a way of doing it. I think we're past that point. I think that would have been a good thing to do right away. Give us a FICA holiday, because again, that's a way of getting money back in people's pockets really quickly. The thing the FICA holiday doesn't solve is all the people on unemployment. I don't know how many we have now. It's like 30 million on unemployment. They don't get any relief from that, right? Because they're not paying into it. So I'm okay with that, but I think that the ship has sailed and we're 3 months into this, and I think there's more effective ways to do this. But this is one that kind of is along my lines of, it allows people to keep more of their money. So I am a fan of that. Again, I just think that we might be past that point for that being necessary. So, well, either I've shocked everybody, or you didn't like my message and you didn't stay on. I haven't really checked. Or you don't have any questions for me, but I know I really enjoyed putting this together. If you have thoughts, other topics that I can cover, if you want to push back and have more of a lively conversation, I know it's so much harder to do this via a webinar versus a live session. So hopefully one of these days we'll get open back up and we can have a debate in person. But again, I really enjoyed this topic. Hopefully you see my passion for some of this stuff, and we have some real challenges ahead of us, but we need some serious people trying to fix this. And I do think this is 20 years in the making with what's been happening with our politicians. And it's time for us to start making some serious changes to deal with these issues, because kicking the can down the road is not the best, is not going to work. The fortunate part is we have American entrepreneurs that are going to push this and continue to move our country forward. We just need a bigger batch of society to benefit from this. And I think that's where a lot of the policy decisions are going to need to be made. And again, start fixing some of this stuff now. So again, thank you for your time. I hope you enjoyed this. Please share your comments, share this. We're going to post this through social media. So if you have any thoughts, please share them, because this stuff is great to talk about. So you all have a great evening, and look forward to our next webinar in 2 weeks. Thank you.